This video presents information about forecasting individual security returns. So far, we've been talking in chapter 10 about estimating expected returns, but the estimations that we've been doing so far are estimations related to aggregate groups of assets. So, estimating expected returns of stock portfolios as a whole, of indexes, bond portfolios, and so on. And here we're diving down a little deeper to examine individual security returns that would combine to form the groups of assets. So basically, individual securities expected returns are almost always based on estimates provided by analysts. So analysts examine data from different assets and then come up with their expectations of that asset's expected returns. However, research has shown that the forecasts of analysts tend to be too optimistic and too diverse. What do you mean by that? That they always estimate a higher expected mean, and they estimate the expected returns with a bunch of error. And so there's too much dispersion, which moves the estimate away from the true value of the mean. So because of this, things have to be done to address the issues associated with analyst data in order to be able to use it correctly. So what's the issue that comes up with using analyst data directly? If we use that erroneous data directly, the one with too high a mean and too much dispersion, we're going to end up with very few securities in our portfolio. And if we have very few securities, we know that that comes associated with higher risk. Okay, so diversification helps to reduce the risk of a portfolio. And so basically, we would try to utilize the information in an analyst forecast while at the same time creating a diversified portfolio. So we've talked about this over and over in the class, but what are the benefits of diversification? The first one, of course, is that there's lower risk than in more concentrated portfolios. We've heard that over and over. Okay, larger portfolios reduce the amount of random noise in the estimates, and increases the chance that the actual extra return is observed. So if there's extra noise, the true return may be hiding in there because there's all this extra variation coming into play that should not be in there to make us get a clear estimate of the expected return. And then the third one is that increasing the number of securities, increasing the number of securities reduces the amount that we're investing in a particular security, okay, due to the analyst's extreme estimate. And so, if we can, by increasing the number of securities, we're able to reduce the effects of that particular extreme estimate, and that helps us to reduce the overall risk as well. So how do we go about diversifying while at the same time utilizing the information given to us by analysts? So the first way we could do that is we could put an upper limit on the amount invested in each security. What does that mean? That means that we say that there's a restriction of, for example, 2% on every security. So if we have 100 stocks, okay, and we say that there's a 2% upper limit, that means the maximum that we can invest in each stock is 2%. So we are guaranteed at least 50 securities in that portfolio. So this is important, okay, knowing the difference between at least and at most. At least means that we can have 50 or more than 50 securities in our portfolio. That means that the minimum number of securities that we can have is 50. Okay, if we had a 1% upper limit, that means no asset can get an investment of greater than 1% of our total investment. Now, if we have 100 assets, if we have a 1% upper limit, that means that we will have at least 100 securities in our portfolio. Okay, because each one is restricted to having 1% as the max percentage of our investment. So keep in mind the at leasts. This could be an important thing to note in the exams. Okay, so a 2% upper limit guarantees at least 50 securities. a 1% upper limit guarantees at least 100 securities in our portfolio. Now, what issues come up if we're just using this simple method to diversify our portfolio? Let's say that there are some assets in which we want to invest a higher percentage. Okay, there's some good asset out there that has a low risk for a high expected return. We want to put maybe 20% of our assets, 20% of our investment into that security, because of our maximizing the way to rule. And if we say we're putting, for example, a 2% upper limit, then even if we want to invest more, we are unable to do that because of our upper limit. So how can we address that? We could allow higher upper bounds for particular assets, but at the same time we can process the analyst data to remove some of that extreme variation that comes into play. So we're going to try to allow higher upper limits, but at the same time make sure that our analyst forecasts are sort of corrected for the issues that we know that they present, okay, which is over optimistic and extreme dispersion in their estimates. So think of it from this perspective. Assume that they forecast a 16% return for an average equity security. Okay, so on average, they're saying there's a 16% return for an equity. But we forecast the market return being 12% for equities. So we can use that information to guide down the estimates of the analysts. Okay, we could first lower all the analysts' individual estimates by 4%, because we noticed there's a 4% difference here between 16 and 12. So we could lower all the analysts' individual estimates by 4%. Okay, and then we adjust all the forecasts towards the mean, okay, to get rid of extreme forecasts. Okay, so once we've reduced every estimate down by 4%, then we could adjust all the forecasts towards the mean in order to reduce the extremeness of those estimates. Okay, so let's assume that there's this stock ABC and an analyst forecasts 20% for expected return for that stock. And now we're trying to find what would be a corrected estimate based on that analyst forecast. We still want to use the analyst forecast, okay, because there's some information in there, but we're trying to find out what errors can we remove from the analyst forecast to be able to best use it. Okay, so the first step, remember, is we're going to reduce everything by 4%. So if that expected return was 20, we're now going to reduce it and it now becomes 16%. Okay, and then our second step was to adjust all the forecasts towards the mean. Okay, so we'd adjust this new number by some percentage, okay, let's say 50% of the difference between the forecasts from the forecasted mean. So our difference was 4%, so we'd adjust this estimate by 50% off that 4%. Okay, so if the difference is 4%, we adjust by 50% of 4%, which is a half. So half of 4% is 2%. Okay, so we take that 16% that we got from reducing by 4, and then remember we're doing an extra correction to move it towards the mean. Okay, so once we have that 16, then we subtract away the 2%. Now our estimate of expected return for this asset is 14%, and we'll use that in our models. So what does this help? It helps preserve the rank order of forecasts, but does not preserve the rank order of what analysts believe are good purchases. Okay, so what do you mean by an analyst believing they are good purchases? That means that they have a ranking of what they think are better stocks based on how much more expected return they're getting relative to the same risk. Okay, so while we're able to maintain the ranking of the forecast based on numbers, we're eliminating the way to determine which stock did the analyst think was better in the first place to buy. Okay, was a good purchase. So then how can we address that issue? Okay, we could use an equilibrium model such as the CAPM to kind of guide us towards that way. Okay, so the empirical CAPM, what is the empirical CAPM? We're going to plot the security analyst's estimate of expected returns against beta. Okay, so we're going to get something that looks like how we estimated CAPM, but except that now we're plotting the analyst's estimate of the return against beta, and then we get a line. Okay, and that line, that whole model is called the empirical CAPM. Okay, the fitted line is going to be the expected return based on the empirical CAPM. So let's take a look at how that looks. So what do? So we define the distance between the analyst's estimate of the expected return and the expected return of empirical CAPM, and we call it alpha. Okay, so remember, these are all these points that are plotted, which are the analyst estimate of expected return against beta. Okay, and we have all these estimates, and then we take this difference. Anything above the line is considered a positive alpha. Anything below the line is considered a negative alpha. Okay, and then we use that, and then we try to minimize, we try to reduce all these alphas to bring it closer to the line. Okay, this line is our expected value based on empirical CAPM, right? So if we can reduce these errors closer to the line, we'd be able to get a more close estimate while still having a diversified portfolio. So basically, every one of these is an alpha. Okay, these are all positive alphas up here. Anything above the line is a positive alpha. Anything below the line is a negative alpha. So we sort of divide every of these alphas by half. Let's say we could make any adjustment. Okay, so basically, all we're trying to do is lower our positive alphas and raise our negative alphas, which means we bring these positive alphas down. We bring these negative alphas sort of up. If you look at what I did here, I basically cut all these errors by half. Okay, so if this was kind of 2 lines above this expected return, now I made it just 1 line above. This was 2 lines below, now it's about 1 line below. Okay, so what do you notice? All these forecasts that were widely diverse are now a lot closer. Okay, we've minimized the dispersion, and so now this would help us get a better portfolio that uses the analyst forecast with less of the error, but it's still diversified. So that's exactly what I said, right? Cutting alpha in half produces a less extreme and more diversified portfolio. So we're coming a lot closer to this expected return. That means that we're less extreme. We're not moving far away from the mean. In the next video, we're going to talk about discrete data and how we go about doing portfolio analysis when we have that kind of information provided in analyst forecasts.